Well, hi there, and thanks for joining in to learn about options for hedging. My name is Jason Ayers. I'm a derivative market specialist by designation. I'm Director of Business Development and a derivative strategist with R.N. Croft Financial Group. I'm a member of the Investment Review Committee, also a member of the Board of Directors. I'm an educational consultant for LearnToTradeGlobal.com, as well as an educator for the TMX Montreal Exchange. As always, we just want to make sure that those of you that are joining in recognize that the information that we're sharing here today is for educational purposes only, and that the options market, not unlike any financial securities market, does carry with it some risks. And although today, of course, we're talking about using options for hedging, it is important to make sure that you understand the risks associated with the different option strategies that you may be considering for your portfolio. So what we're going to look at, first of all, is just a quick review of the rights and obligations associated with a put option. We'll talk about what is a protective put, and we'll compare protective puts versus stop loss orders. We'll discuss utilizing a protective put to lock in a profit. We'll identify some important characteristics within the approach to contract selection. We'll talk about some of the different risks that we may be looking to manage within our portfolios, and we'll talk about the different types of hedges that we can also put on depending upon what we feel is important as far as managing risk within our portfolio. So with that in mind, let's just first of all take a quick look at a put option basics. Of course, remember that a put option is a contract, and you can be the buyer and or the seller of that contract. So the put option buyer pays a premium and secures the right to sell the underlying security at a specific price. That right to sell at that specific price is valid for a specific period of time, and that is something that we have control over, which we're going to discuss as we move forward throughout the presentation. Now, that put option buyer will pay a premium to the put option seller, otherwise known as the put option writer, and that put option writer is actually getting paid to take on an obligation to buy the underlying security at the agreed upon price, and that obligation is going to be valid for a specific period of time. So when we look at the contract terms, just as a quick review, remember that one contract controls 100 shares of the underlying security. Each price of the contract is listed in a per share format, which means that we need to multiply the premium in order to come up with the actual cost of that contract. So there is a 100 unit multiplier. So one contract represents 100 shares of the underlying security. So if we are looking at a quote within our options change for $1.25 per contract, we multiply that by 100, and the total cost for that contract is going to be $125. Now, what is a protective put? In its simplest terms, we are already in possession of a certain number of shares, or we are looking to buy a certain number of shares and subsequently benefit ideally from the appreciation of those shares. But in order to hedge the downside risk associated with owning the shares, we're going to buy a put option, which is basically going to act like an insurance policy. So we're going to pay a premium that is going to secure the right for us to sell the shares that we have purchased or we already own at a specific price. And that right is going to be valid for a specific period of time. So one of the opportunities here is that we can create a position, we can benefit from the upside on the underlying shares, but we can pay a premium and basically buy an insurance policy, which will guarantee that no matter how low those shares drop within the specified period of time that we've allocated, we will be able to get out or sell those shares back to the market at that specific price. So let's take a look at hedging an individual stock. So let's take a look at Doug here. So Doug is buying 300 shares of company XYZ at $80. Now, of course, Doug is anticipating a rally in those underlying shares, and there's an expectation that the share price is going to hit $90 within a certain period of time. The challenge, of course, is that if Doug is wrong, that there is an unidentifiable risk exposure. And so what Doug's looking to do is create a hedge that is going to limit and reduce the risk if the shares drop instead of go higher. So what Doug is going to do is Doug's going to buy an $80 put and pay $2.50 per contract, which is expiring within 4 months. So what does that mean? Well, what that means is that Doug is paying $2.50 per share to secure his right to sell those shares at $80 regardless of how low they drop within a 4-month period. Now, let's take a look at what Doug's expectations are. I always like to look at things from a technical perspective. It's a little easier to sort of identify, just really what the characteristics of the stock look like over a period of time. And so you can see here with company XYZ, there's been a pretty significant sell-off from that $90 level. You're now sitting down around that $80 level. Expectation is that there's going to be an appreciation back up to retest those highs at 90. But given the sell-off that has taken place, Doug's not 100% sure whether or not there may be a continuation lower, conceivably even back down to, let's say, $72, $73, $72, where the stock was trading at not so many months ago. So if we take the number of shares that Doug has purchased at $80, it's a $24,000 capital allocation. We then need to consider the cost of the put options that he's purchasing at $2.50. Well, because each contract is covering 100 shares, and because Doug has purchased 300 shares, he's going to buy 3 of those contracts with the $80 strike put option. And as I mentioned, those options are going to be expiring in 4 months. Now, what Doug's done is he's paid a 3.13% premium, and he's guaranteed that no matter what happens to the stock over the next 4 months, he's able to get out at $80. Now, if the shares go higher, fantastic. That's exactly what he's expecting them to do. But if the shares happen to drop within that time frame, he already has his exit strategy. So right away, he knows maximum risk for the next 4 months on this position is 3.13%. So he's got the complete upside opportunity of the stock, plus he gets to keep the dividends, but there's a defined worst case scenario. Now, let's look at a couple of different scenarios here. Let's assume that the shares actually proceed to drop over the next month. So XYZ shares drop and Doug is concerned. What Doug can do is exercise his right to sell the shares at the $80 anytime prior to expiration. So just because the option contract, the put option contract, is valid for 4 months, doesn't mean that Doug has to stay with the position for that 4-month time frame. What Doug can do is basically just contact his broker, or ultimately could conceivably, if he wants to exercise his right earlier and sell the shares, or can simply just wait until the 4 months is up and then just let the option, what's referred to as auto exercise, on his behalf at expiration. Either way, Doug can start considering some possible actions in order to manage for the position that he is currently in. Now, the other scenario is, let's say Doug still thinks that there's the possibility for the shares to increase, but wants to monetize the profit that's been generated with the put. So XYZ shares proceed to drop, but Doug remains bullish. Doug can sell the put option and realize the profit on the put, and then can continue to simply own the shares, recognizing that there is now an adjusted cost base by subtracting the profit from the put from the cost of the shares, right? So any income, any profit that's been generated from selling that put option can help go against lowering the break-even point on the shares that he continues to hold. Now, in scenario 3, let's say the stock rallies. Well, the investor can continue to hold the original shares and can fully profit from the upside, allowing the put to expire on expiration. Just recognize that when Doug paid that $2.50, that $2.50 was made up entirely of time premium. So unless the shares drop in value to generate an intrinsic value, all the time value within that option contract is going to disappear on expiration, which means that while Doug has benefited from the upside of the stock, he has to take into account that that $2.50 that was paid for the premium is no longer valid. And so what happens is that ultimately raises the break-even point of the investment. So if you buy the stock for 80, for example, and you pay $2.50 per share to hedge it, your break-even point ultimately becomes $82.50. So your profitability comes in after the shares have rallied beyond the cost of the put option. So let's consider the differences between a protective put and a stop loss order, because I know a lot of investors will say, well, why don't I just use a stop loss order? I can manage my risk using stop losses, and that's a valid strategy, but there are some very important considerations and differences when looking at using a protective put versus a stop loss order. So let's take a look at that comparison here. So recognize that a stop loss order is an order to sell a security when it reaches a certain price. Now, the important consideration is the price that you allocate for that stop loss order is really just a trigger point. When the security reaches that price, a market order is triggered and sent to the market for execution. So you're not guaranteed to get out of the position at your exact stop loss price point. What happens is that price point you put in is a trigger, and then the order is sent to the market, and ultimately you'll get filled at the market price, which, remember that there could be a significant difference between where you put that order in as a stop loss and where the market is trading at presently. What it does is it basically forces the sale of the shares at a lower price than may be expected, especially if there is what we refer to as a gap down in the value of the shares, which you'll often see. The market closes and maybe an earnings report or some sort of industry hiccup takes place, and then all of a sudden the stock opens up repriced lower because of that. That's where we would consider that to be a gap down. So what the use of a protective put does is it eliminates the risk of volatility in the selling price. So understand that that the protective put trades completely independent of the underlying securities, and so because of that, we can hold that in place, and no matter what the underlying shares do, it is up to us ultimately to decide whether or not we want to exercise our right to sell the shares. So we actually can sit back and be a little bit more comfortable and confident because of this protective put, recognizing that the market noise that's taking place is not going to force us out of the position. The selling price is guaranteed to be the strike price of the put option purchased, regardless of where the price of the underlying is trading at. So let's look at quickly at the disadvantage of a stop loss. So stop loss orders are at risk of market volatility. Well, what do we mean by that? Well, of course, you may buy the stock at 80 here in Doug's example, and you put a stop loss in at 75. So what you're saying is, hey, you know what? I'm okay with a $5 loss on this particular position. If it drops $5 to 75, get me out. Well, quite often that happens, and you see the stock drop to that level, and then ultimately a stop loss triggered, but then of course turns around and hits your target. So when you've got a stop loss in place, what happens is you are vulnerable to that volatility, trading volatility throughout the day. It may be just a little bit of a knee-jerk reaction, market noise that pushes the stock down, maybe has nothing to do with the underlying company and where it's likely to go. And so the stock drops, it hits that trigger point, you're out of the trade, and then it turns around and continues to move to the upside. With a protective put, you are always guaranteed to be able to sell your shares at 80, no matter how low that stock drops, and there's nothing forcing you out of that position. So you can weather that volatility, make some educated decisions that are not influenced by emotion to decide whether or not you want to continue to stay with the trade. The other consideration is what we would refer to as an overnight gap slippage. So that's ultimately when you are, looking at, for example, buying the shares on a Monday. You've bought the shares at $80. You've put your stop loss in at 75, and what happens is, hey, you know what? The stock drops during the day, doesn't hit your stop loss, so you're good for another day. But maybe an earnings report comes out, maybe something, again, some sort of a sector or industry related news comes out, and it changes the perspective on the underlying securities. And all of a sudden, bang, you get this gap down. Now, what happens is, because you've traded through, or the stock's traded through your stop loss, when the market opens up the next day, your order is triggered to go to the market as a market order, and your fill price is going to be wherever the stock is opening up that day. So as you can see here, where the intention was to limit your losses at 75, because there was a gap down overnight and the stock opens up now at a new adjusted price of 73.25, that's where you're getting out. Again, if you've got the protective put in place, you don't have to worry about that gap down. Your option contract premium is going to reflect that difference between where the stock's at the $80, or where the strike price is at the $80, and where the underlying security is trading at presently. So in this example here, what you can see is Doug was really, really wrong. And so while the stock was purchased at 80, along with that protective put, and while Doug's intention was to ride that stock all the way back up to 90, what you'll see here is that over the next couple of months, the stock dropped all the way down to 65. So if we take a look at how that plays out, the average investor who didn't integrate that protective put would be down about 20%. And emotionally be very concerned and upset as to whether or not they should get out. Do they hold on? At the end of the day, there's a lot of anxiety around being, and what's referred to as an unwilling investor. What seemed like a good idea at the time, after that 20% drop, is not looking like such a good idea. But again, the investor may be anchored to the investment and not wanting to get out and incur that loss. But if we look at the protected investor, as in Doug's case, Doug can exercise his right to sell at $80, is then free to step back and decide whether or not it makes sense to buy the shares back at the current levels. Is it still a good investment down at this level? Doug's got all his money back minus the $2.50 that he paid, or the 3.13%. So rather than being 20% down, Doug now has a loss of 3.13% and can turn around and say, and ask, do I want to get back in, or do I want to find another opportunity? So one other way, and the ideal application, is for locking in profits. So one other way that you can use the integration of a put option is if your stock appreciates as expected and you want to hold on, but you don't want to lose those profits. So you could buy a protective put to lock in the sale price while continuing to profit from the upside. Now, what that means is that you're going to give up a little bit of your existing profits in order to integrate the hedge, because remember, the protective put is going to cost you something. But if you've made $10 on the shares, and you give up $2.50 to buy a protective put, you've just locked in your a large percentage of your profits. Plus, you have the opportunity to continue to hold the shares for an extended period of time, if to take advantage of the shares moving higher. So again, an example might be, bought the shares for 80, shares have rallied all the way up to 90. You could buy a new protective put at $90. Now you've locked in the sale price at a profit. without cutting off any further upside. So it's a way that you can kind of continue to hold on to the position, roll your protection higher, benefit from a continuation in the trend without having to worry that you're going to be giving up a significant amount of your profits in the event that the market turns around and goes against you. You, once again, from a psychological and emotional perspective, you can sit back and make an educated decision without worrying about how, without having to deal with the emotional influences of being invested and having a significant amount of uncertainty around the profits that you're going to lock in and the risk associated with staying with the investments. So now let's consider contract selection. So there's a number of different ways that we can use put options as a hedging strategy. And when we're actually building out these strategies within our portfolio, we really want to consider what and how we want to hedge. So what are we hedging for, and how do we want to hedge this? And so we could use what's referred to as an at-the-money option. Remember, options are categorized and priced based on their relationship to the underlying stock price. So an at-the-money option is a contract that has a strike price close to where the stock's trading at presently. Those option premiums tend to be higher. But what that means is that the investor is guaranteed to sell the stock close to its current price. Now, remember, you're going to pay a higher premium, but I kind of look at it, think of it like the deductible on your car. If you want to lower your deductible, your insurance deductible, you're going to pay a higher monthly premium. And so if you choose an at-the-money option, you're reducing your deductible on the stock, but you're paying a higher premium on the option contract for that benefit. Now, you could turn around and you could use an out-of-the-money option. The out-of-the-money option is a less expensive alternative. Really, what happens is, as an investor, you're going to assume the additional risk of loss between where the strike or where the stock is trading at presently and the strike price of the option contract. So when you buy an out-of-the-money put, what you're saying is, I'm okay with, a $2 risk on the underlying stock. So you buy the stock at 80, and then you let's say buy we can use 75. You buy the stock at 80, you buy a 75 strike put. What you're saying is, I'm okay with a $5 loss on the underlying stock, and I'll pay the cheaper premium for the 75 strike put just in case this does not go in my favor. So the out-of-the-money option would tend to be the solution if you are very, very, very bullish and you believe that there is a higher probability of upside versus downside. What that means is that you're assuming additional risk of loss on the stock before the protection becomes effective. There's your deductible. Now, as far as expiration month selected, what are you protecting your stock or your portfolio from? Is it a shorter term technical risk? In which case you may want to go with a 1 month, 2 month option. Is it a longer term fundamental risk? You may want to build in a longer dated option contract. Interesting strategy that you can apply there is you could buy the longer term put option, and then you could in fact sell call options like the covered call strategy in order to help offset the cost. So there's ways that you can combine strategies in order to offset the cost of the protective put and make it a little bit more feasible if you're using a longer dated contract. Are you hedging company earnings? There's a lot of companies have weekly options available, in which case you could use the weekly options to hedge out this event-driven risk associated with the stock that you're holding. Are you looking to lock in the sale price of your shares to a new year as a tax deferral strategy? So what you do is, let's say you're profitable in December, but you don't want to, lock in those profits as part, because of a tax event that might be taking place in the current year. So you could buy a put option that expires, let's say, the following January, and subsequently hold the position into the new year, recognizing that no matter what happens, you have an identifiable risk and identifiable profit that you can then deal with in the new tax year. You also may be looking at hedging out broader stock market risk, in which case you might want to just utilize an index ETFs such as the XSO options that are available on the Montreal Exchange to hedge out your risk, the risk associated with the TSX S&P 60 as part of an overall portfolio hedging solution. So lots of different reasons why you may be looking to protect the stock or your portfolio, and those reasons are going to be influential in what strike price and expiration month you're going to select. Now, we also want to consider what types of risk are we managing for. So systematic risk is market risk, such as geopolitical, economical, could be, interest rate announcement, could be some sort of a, trade or tariff consideration, but whatever it is, the consideration is it's going to have a broad-based impact on the markets and poses a risk to the entire portfolio. That kind of risk is difficult to diversify out of a portfolio, so that's where you may want to look to utilizing an index-based option, such as the SXO, which will allow us to hedge for a broader market risk in a diversified portfolio. Now, unsystematic risk is company or industry specific. So that is a little bit easier to diversify out of a portfolio, and that's where you'll go in and use an individual stock option associated with this, with the stock that or the company that you're concerned about, and build a hedge just specifically around that particular company. Or you could look at an index, or sorry, a sector-based exchange-traded fund to hedge out risk associated with a particular sector, such as the gold miners or what have you, if you're looking to hedge out just a particular component of your portfolio. But again, understanding the different types of risks and how they're going to impact your portfolio will also help with making an appropriate decision as far as what to use as far as a hedge and how to use it. Now, there are also different types of hedges. There's perfect hedge and imperfect. There's a perfect hedge and an imperfect hedge. Now, the perfect hedge is the type of hedge that tries to completely remove all risk of loss through optimizing the number of puts needed to hedge. Now, we talk about option Greeks in one of our recordings, and so one of the Greeks is known as the delta, and so option contracts at different strike prices have different deltas. The delta is how much the option contract is going to adjust for every $1 move in the underlying security. So if you're looking to try to create a perfect hedge, you've got to recognize that the stock has a delta of 1. It goes up $1, you make $1, it goes down $1, you lose $1. And then you may, in fact, have to go in and buy additional put options depending upon the delta of those options that will add up as close to 1 as possible. You may also have to look at what's referred to as beta adjusting a portfolio. So again, if you have a diversified portfolio, that portfolio is going to track an index to a certain extent, but not perfectly. And so you may have to determine the beta of your portfolio, and then subsequently choose the number of index options that will effectively hedge out the risk associated with your portfolio's movements comparative to the underlying index. It gets a little bit more complex mathematically. In fact, we do have some recordings available on the MX site that talk about beta adjusting a portfolio. Very interesting if you're somebody that's looking at applying a much more broad-based hedging strategy. Now, imperfect hedges are more common. Really what you're doing with an imperfect hedge is you're seeking to reduce volatility and limit the effects of a rapid drop in the broader stock market. So again, not trying to delta hedge, not trying to beta hedge, just getting in and saying, okay, I have X exposure to the markets here. This particular company is of concern, so I'm just going to go in and I'll buy some put options to hedge that. But again, not looking for an exact dollar for dollar hedge, just something to reduce the volatility and lower the downside and identify the risks, just to so that you can manage your portfolio more effectively. And again, just sleep more soundly at night. Recognize that a perfect hedge tends to be more expensive because you are typically buying more options to hedge the portfolio than that of an imperfect hedge. So just a couple of points to summarize here. When you're utilizing protective puts, it prevents you from feeling trapped in a losing position. A lot of investors become unwilling investors because they don't want to take a loss. And when you integrate a protective put or a hedging strategy within your portfolio, what it does is it immediately identifies your maximum risk exposures. You know how much you are at risk of losing and over what time frame. And so no matter what happens with the market, you know exactly what you're dealing with. It also will prevent you from making a short-term trade into a long-term holding. In other words, you may enter into a position with the expectation that it's going to move in your favor very quickly. If you build a hedge into that strategy, you can just, you know your maximum risk, and you can just close that trade at a minor loss, find another opportunity. From a psychological perspective, an emotional perspective, investors that tend to invest for a short-term opportunity, when it goes against them, there tends to be a lot of rationalization as to why they should hold on to the trade, because it's a good stock, or let's buy more, because it's a better value down at these levels. You start rationalizing why you should hold on to a trade, which ultimately was put in place because you had short-term objectives. So by adding that protected put, you can filter those emotional influences out and really make the appropriate decision within the time frame that you had originally allocated. Basically, you've got control to reposition. Again, if you still like the stock and it's a short-term trade, you can sell the put, readjust the position. You can get out of the entire position, buy more at the lower price, sell the put and use the profits to buy more shares at a lower price. There's so many different things that you can do. You've got choices. And you don't have those kinds of choices if you just simply go in and buy and hold the underlying stock. Important consideration is that these hedging strategies are all available within your registered account. So if you want to manage risk within your RSPs, your RESPs, your RDSPs, your TFSAs, your LIFs, RIFs, LIRAs, whatever it is that you're managing, you can integrate these strategies within your portfolio to help again, lower your risk exposure, reduce volatility, and, take more decisive positions without, being as concerned about the market conditions. Couple of risks and considerations you really need to be aware of. Buying puts on stocks has a bit of a trading / market timing element to them, especially if you're using technical analysis, moving average crossovers, support resistance levels, that sort of thing. So, you want to be comfortable in that side of the of market analysis as well. The other consideration is continuously buying expensive puts can result in accumulated losses that impact the longer term returns. Reason being is that, if a stock is going down and you're continuously buying put after put after put after put, recognize that the premium that you're paying is adding to your cost basis, right? So the more puts you purchase on a stock, the more that stock needs to turn around and go in your favor to accommodate. The way I kind of look at it, and I'll leave you with this, is that I kind of look at protective puts as almost like a get out of jail free card. Once or twice, maybe the stock's not doing so well, you use that protective put as a second chance. But at some point, you've got to admit that you're in a bad investment, and you got to move on and find another opportunity. Always remember, folks, that there's lots of information available at the Montreal Exchange site. We've got blogs through our optionmatters.ca blog site. There's lots of trading letters, videos, webinars, trading guides and strategies, calculators and simulators, and a really cool screening software called Options Play available. And of course, always take advantage of the webinar and recording library that you have available, on the National Bank site. It's all about repetition and reinforcement. As always, thank you very much for your time. I really do appreciate you sitting in on this session, and I look forward to presenting the next video.